One of the more common questions we get from clients or prospective clients is around appreciated stock, and the question is often, "Hey, I've got this position that's gone up significantly in value. It's become too concentrated, too big a portion of my overall net worth, but I don't know what to do because of the tax bill that I will have to pay if I reduce my exposure or sell it." And so in today's episode of Cuppable, we are going to review 5 strategies to consider if you have appreciated stock. That said, my name is Michael Dunham. I am the Director of Planning here at Fontana Financial Planning, and welcome to Cuppable. Cheers. So, couple things that we want to consider if we have a large appreciated stock in a taxable account that's become a concentrated position, and we just recognize like, hey, it's done really well, it's time to take some off the table and reduce our exposure. So the first strategy that I will bring up is the idea of gifting appreciated stock to charity. So obviously, with this strategy, the first and most important thing is you need to be somebody that's charitably inclined. We don't want to give away money if we don't have any intentions on giving away that money. But if you are somebody who does have charitable desires, gifting appreciated stock is often the most tax efficient way to gift. And there's a couple things to know there. So, one, if we take appreciated stock and we gift it to a charity instead of gifting cash, the way that that works is you get an itemized tax deduction for the amount of the gift. So let's say we gifted $10,000 of appreciated stock to a charity, and that stock had a $1,000 basis. So we paid 1,000, it's grown to 10, we gift it to charity. We get the same itemized tax deduction that we would get if we had given $10,000 worth of cash to that charity. And then when the charity receives the appreciated stock, because they're a tax exempt organization, they have the ability to turn around and sell the stock and pay no taxes on the $9,000 of growth. So we're able to avoid the capital gain on the $9,000 worth of growth in this example, and we get the itemized tax deduction for the full amount of the gift, as long as it's something that we've held for at least a year. That's kind of the caveat that you have to be aware of there. The other idea that I'll bring up is the idea of bunching giving and using what we call a foundation account, or also known as a donor advised fund. So let's say we have a really high income year this year, and maybe we're retiring next year, or something's changing about our situation that's going to cause our income to drop, where it makes sense to try and get more tax deduction this year. One thing that we can do is we can front load multiple years worth of giving all into one single year. So to kind of continue the example that we used earlier, if we had $30,000 of appreciated stock with a $3,000 basis, and we wanted to front load 3 years worth of giving, we could take that $30,000 of stock, move it to a foundation account. The foundation itself is a tax exempt organization, so it can sell the stock, it can rebalance into a more diversified portfolio, and then you have the ability to gift stock to the end charity that you would have gifted to from there as you see fit. So if the plan was, hey, I'm going to give $10,000 to this organization each of the next 3 years, we put $30,000 of appreciated stock into the foundation account. It sells it. We don't pay the capital gains on the growth. That money is invested, has the ability to continue to grow tax-free from there. And then you can make your ordinary $10,000 gifts each year that you would have planned to make just ordinarily. It just comes out of the foundation account. The second idea that I will bring up is what's called a securities-based line of credit. And so essentially what this is it's the ability to borrow against your investments without having to sell them. Now, I'll say here in our firm, we prefer to utilize this really if it's a short-term need. So an example would be, hey, I'm buying a new house and I don't want to sell investments, but I haven't sold my old house. So I need to come up with some cash to bridge the gap to be able to make the purchase of the new home. And if we have securities that are up significantly and we're going to have to pay a large tax bill, but we know that money is coming back into the account here in the next, call it 3, 6, 9, 12 months when we sell the old house, a securities-based line of credit is a great way to bridge that gap. And essentially, the way that it works is, let's say we have $1 million investment account, and that $1 million is comprised primarily of appreciated securities that are going to create a large tax bill. And let's say we need to come up with $400,000 to help with the purchase of the new house in this example. What we can do is we can set up a line of credit against that $1 million portfolio, borrow against it to get access to the $400,000 so that we can make the purchase of the new home. There is an interest rate that's going to be charged on the $400,000 that we've borrowed, and that rate floats, and it's kind of tied to a spread between short-term interest rates. But we don't have to make any payments, and we don't have to sell investments. So we're able to keep our investments invested and growing and not realizing any gains. And then let's say 6 months from now, we sell the old home and we get an influx of cash. We can take $400,000 of that influx of cash, pay off the line of credit, and now we've maintained our appreciated stock and we've not realized significant gains in the process. The third idea that I'm going to bring up is what's called an exchange fund. And so an exchange fund is essentially the ability to take a concentrated appreciated stock position and pool it together with other people who own other appreciated concentrated stock, and they're trying to accomplish the same objective. So let's say we have $100,000 of some appreciated stock that we don't want to realize the gain and pay taxes, but we recognize that it's becoming too big of a portion of our portfolio. I'm actually going to say $1 million. So this is really more common when you have significant exposure to a stock. So let's say $1 million for the sake of this example. So we have $1 million of appreciated stock. It's going to create a significant tax bill. We can, as long as we can find an exchange fund that's willing to accept it, because ultimately what the exchange fund is trying to do is they're trying to replicate some sort of market-based rate of return. So they don't want to get overexposed in any one name. So a lot of times what'll happen is a stock runs up and everybody who owns that stock looks to get into an exchange fund, and the manager of the exchange fund kind of has to put their foot down at a point and say, hey, we've accepted too much of this stock, so we need to stop accepting this stock or else we don't really achieve the objective of our fund. So as long as we can find an exchange fund that's willing to accept our stock, we can take our $1 million worth of stock, put it into the exchange fund, and then we get the rate of return that's tied to the overall fund. So everybody who's put their stock inside of this fund, our performance is pooled together and we all receive the same performance from there. Now, there's a couple things to know about exchange funds. Typically, there's some sort of lockup period because the manager doesn't want you to be able to turn around and take it right back out. It makes their job very difficult. And so oftentimes there's a lockup period of, call it, 7 years or something, that you need to be aware of, because if you plan to access this money in a short period of time, this may not be a great solution for you. But if you have a long time horizon and you're looking for diversification, exchange fund is something that may be worth considering. The next idea I'm going to bring up is the idea of gifting to kids. And so there's a couple ways that we like to do this. And I'll say this is largely driven not only by your situation, but like your kid's situation. How old are they? Are they making any money? Things like that. And so the strategies can differ for kids that are 18 years or younger versus older kids. But I'll use an older kid as an example. So let's say we have a young adult child who maybe they're in school or maybe they're out of school but not making money yet, and they have the ability to sell long-term investments and pay no taxes. So essentially there's a 0% long-term capital gains bracket that if they're making little to no money, they likely fall into, and likely in that scenario, mom and dad may be financially supporting their lifestyle. So instead of selling investments and realizing capital gains at your own rate, when your children have an opportunity to realize capital gains at no rate, what could be considered is, let's say we are going to give them $20,000, give them $20,000 of your most appreciated stock. They have the ability to turn around and sell that stock. And as long as they're in the 0% long-term capital gains bracket, pay no taxes on it. So $20,000 stock with maybe a $2,000 basis, there's an $18,000 gain there. As long as that $18,000 gain falls in the 0% long-term capital gains bracket, they can sell it. They'll pay no taxes. You avoided $18,000 worth of long-term capital gains at 15, 18.8, 23.8, some much higher rate. And so it's a very tax efficient way to gift money to your children and help pay for things, or to just, give them a head start in life by gifting them money that they can have in an investment account, growing for a very long time. The last idea that I'll bring up, and I'll say sometimes, depending on needs, this, even though it's not ideal from a tax standpoint, sometimes it's the best solution, which is to sell the stock and pay the taxes. So we have a saying that you don't want to let the tax tail wag the dog. And I'll say it's a big mistake that a lot of people make, is sometimes they're just in a position where the smartest thing to do is sell some stock and realize some gains and accept that, hey, we have a position that did really well and we've benefited from that, but it's smart to take some chips off the table. And sometimes the best solution there is to just sell some or all of the stock and realize some gains. Now, I'll bring up a couple of considerations around that. So one would be being tax aware as you sell. And so what I mean by that is, a lot of times people have different lots of stock. And so a very common example where somebody may find themselves with a concentrated stock position is if they work for an employer and they receive employee-based compensation. So like a restricted stock unit or RSU that vests every year. And they've been with the company for a number of years and they've had a number of vestings, and all of a sudden their stock is worth, $1, $2, $3 million or something. And they want to reduce the exposure. Oftentimes there's going to be multiple lots, because every time they had a vesting occur, it created a new lot. And the stock maybe has fluctuated over time, where those different lots are going to have different gains and different tax bills associated with them. And let's say somebody maybe has a $3 million stock position in their employer, and they want to reduce the exposure and maybe cut it in half, take it down to $1.5 million. Well, one thing that we can do is we can go in and we can pull up all of the different lots, and we can figure out what's the most tax efficient way for us to sell $1.5 million worth of stock. And one warning I'll give is, a lot of times if people aren't paying attention, the most common way that an account is set up, and I'll say we review this whenever prospective clients come to us, and a lot of advisors make the mistake of not paying attention to this, and they just set up the cost basis method as first in, first out, meaning the oldest shares are going to be the ones that are sold. And what we typically know is that usually the oldest shares are the shares that have the biggest gain, and that's going to put you on the hook for a much bigger tax bill than you may have otherwise needed to pay. So being strategic about what lots you sell is a way to reduce your exposure, but also not pay more taxes than you had to pay in the process. And generally, when you sell an investment, as long as you've held it for a year. So in this example, that's one thing that's important to pay attention to, is we don't want to, potentially, we don't want to sell a position that's still short term. So like a mistake that could be made is maybe we're 11 months into the 12-month holding period. And as long as we wait a month, it's now long term and we get better tax treatment than if we sell it here today. So that's one thing to be aware of. But as long as we've held the position for at least a year, essentially what happens is capital gains get stacked on top of other income, and then you will owe taxes based on whatever rate or rates those capital gains fall into. So there is a 0% tax bracket, as I mentioned before. If you're somebody that's working and making money, a lot of times you're going to be above that 0% bracket because of the income that you make, where the next bracket is 15%. there's a net investment income tax of 3.8% that gets charged if you're single at $200,000 of income, married at $250,000 of income. So a lot of times 15 turns into 18.8%. And then if you're in the top tax bracket or one of the top tax brackets, the capital gains rate goes to 20%. And then generally you're subject to the net investment income tax in that situation as well, where you may owe 23.8% of the gain portion. And so what we're big fans of is if we are going to realize significant gains where we know there's going to be a tax bill, when we sell the stock and realize the gains, we project out what the tax bill is going to be. We take that money, we set it aside so that it's not invested and exposed to the market. That way, when it comes time to pay the taxes, we know the taxes are covered and we can take the rest of the proceeds and diversify them into a portfolio that makes more sense for the client in their situation. So again, the 5 strategies that we went over today: 1, gifting to charity; 2, a securities-based line of credit, borrowing against the investments for a short-term need; 3, an exchange fund, pooling your appreciated stock with other investors in a similar situation to get a more market-like rate of return; 4, gifting to kids if it's tax advantaged to do so; and 5, selling the stock, paying the taxes, but being aware of the best way to do that. So I hope you found this episode helpful. If you did, down below, there's a button where you can subscribe and you can watch more great financial planning content that we look to produce. If you would like to talk about your situation and how some of these ideas may be applicable to something going on in your life, we do have a link down below in the show notes where you can schedule an introductory call with a member of our team, and we'd be happy to talk through some options and see how we might be able to help. That said, I'll go ahead and wrap us up today by reminding you to rebalance until rich. Thanks for joining. Cheers.